You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Boot Camp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. If you trade options, you've got to ask yourself, why would you choose an options trading platform that puts investors first? At public.com, there are no commissions or per contract fees. And more importantly, it's the only platform where you can earn a rebate on every single contract traded. That means you can save on your options trading costs and keep more of your capital in play. Whenever you trade options on Public, your savings are automatically applied. So, don't change your strategy, change your platform, and see the difference in your bottom line. No commissions, no per contract fees. And it's the only options trading platform where you can earn a rebate on every contract traded. To learn more, please visit public.com/optionsbootcamp. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, listeners, welcome to episode 2 of our doubleheader. If you're listening on demand, it's just the episode for this week, so welcome. My name, of course, is Mark Longo from theoptionsinsider.com. Immediately after this show today, I'm going to be diving into a doubleheader of our newest show to hit the network, The Futures Rundown. Yet another reason that you should be subscribed to the full network, listeners. If you're not, you're missing out on all this stuff. I'm constantly amazed how many people are just listening to one show. Could be boot camp, could be vol views. And hey, we love you all. Pick your poison, whatever floats your boat. But you're missing out on a whole bunch of other stuff, nearly a dozen shows. So wherever you're getting this, make sure you go to Apple Podcasts, you go to Spotify, YouTube, wherever you get it, Audible, our website. And then go to the full network feed. That's got everything there. You won't miss a single thing out there. If you like what you hear, throw us a 5-star review. Dan, our 5-star review this week made me laugh. First, it seemed like he hates the show. I couldn't understand it with the title. But then he gives us 5 stars and raves about the show. So this just shows, listeners, we can take it. If you don't like us, that's fine. We'll even give you a little airtime too. But in this case, Dan, it's kind of hard to tell. So this is a 5-star review from iTunes. And the title of the review, Dan, is, by the way, Dan Passarelli from Market Taker Mentoring, a.k.a. the black-hatted one. Mr. P, welcome back to the show, sir.
Hey, great to be here, Mark.
So the title of this review, Dan, is Puts Me Right to Sleep Every Time.
Oh, that's wonderful.
So I was like, oh, well, okay, I guess this guy hates the show. But then he gives us 5 stars and a whole bunch of smiley faces and everything else, whatever you can do in these reviews. And he says, these guys are the best, mixing some amicable banter with market commentary and insights. We have amicable banter, Dan. Wow, who knew? I have been listening as I go to bed for over 2 years, and the show is the best sleep aid I have ever found.
Oh, man.
So there we go, listeners. Listen, if for no other reason, then we'll put you right to sleep. I think it's mostly Dan. Dan can sometimes be a little sleepy on the show. You know, he hasn't had his afternoon lunch or coffee yet. So there we go. 5 stars.
Oh, my God.
That one just put a smile on my face. Kind of cracked me up. As we keep on rolling into a little bit of the old options drills.
Colin Bunch. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, listeners, welcome to Options Drills, where we break down a little bit more advanced options concept or technique, or just a strategy, a tip or trick that the pros use in the options world we want to convey to you out there. And Dan, this one this week came from you, actually. You suggested it on the show recently that it was an important topic. Maybe you want to sink our teeth into a little more. The notion of the trade size or allocation. It's not a thing, surprisingly, we've ever really discussed that much here on the show. We've been doing it for over a decade. We talk all the different strategies. Sometimes the base level stuff, almost the seemingly obvious stuff, falls by the wayside. In this case, trade size. So I know this is your baby. I'll let you run with it a little bit here. A thing that's also near and dear to you over there at MTM. You guys talk about this a lot. Let's talk about that a little bit. Trade size, your trade allocation. Why is that such an important thing?
Well, because it's a tricky thing when it comes to options. Like a lot of people, when they first start out with options, they're like, oh, I'm going to trade small. I'm going to trade 5 lots. But a 5 lot in forward options or a 5 lot in Priceline options could be just like a massively differently, sized trade from a risk standpoint. And so what can happen sometimes is somebody unknowingly puts on a much, much bigger trade than they should be doing or that they wanted to do, because they're not thinking about the best way to allocate, resources to that trade and to size it appropriately.
All right. So Mr. P, or what did I listen to call you? Sergeant Passy? Sergeant Passy. So Sergeant Passy, I roll into the ivy-covered halls of MTM and I say, Sergeant Passy, I want to start trading these options. Where do I start? How small should I start? What do you typically counsel people?
Okay, well, for first starting out, I encourage people to start out paper trading, so $0. And then at some point you have to move on and actually trade. And there are some people who are just like, look, man, I can't take it seriously if I don't have skin in the game, so I need to skip the paper trading part. And I do respect that. But once you're trading real money, I encourage people to start as small as possible. Notwithstanding what I said before about a 5 lot in forward and 5 lot in Priceline are two different things. I encourage you to trade 1 lots, but maybe not the really, really big 1 lots, not selling naked puts in a $1,000 stock. So yeah, I encourage people to, just speaking generally for now, so far, to start out really, really small. And that's regardless of how big of an account you have. I give the same advice to people who have a $10,000 account or a $10 million account. Doesn't matter.
Couple of things. First off, I definitely agree with the paper trading thing. That's not something we talk about enough maybe on this show. Maybe you need to do a whole show on paper trading. Sometimes people, rebel against that. You're right, because the fills can be a little wonky. Do they fill you mid-market? Do they fill you on the bid or on the offer? So that's going to impact the efficacy of some of the strategies in paper trading. The lion's share of you and what you're going to do out there, at the end of the day, paper trading is a great starting tool. So don't undersell that, listeners. Don't put real money to work until you really know what the hell you're doing out there. Until you listen to a show like this, till you've studied and researched and really feel ready. And then there's no shame with starting with 1 lots. I don't know about you, Dan, but I can vividly recall my first ever options trade. I just gotten out of school. I just gotten recruited to come out here to Chicago to become an options market maker. So I was like, I'm an options pro. I know all about these options things, right? So I still had a small account. So I bought a 1 lot of out of the money calls in Microsoft, and this was the go.com times, right? So of course it printed money. It made like 5 handles for me. And I was like, I'm a genius. My 1 lot of Microsoft calls made me a fortune. So yeah, you could do well even with 1 lots. And at the end of the day, you're not going to hurt yourself too much. So I think starting with 1 lots is a dramatically undersold and underutilized thing. Start very small. Go read the Market Wizards book. Tony Saliba talking about doing his one lots as a market maker on the floor, right? You're not bigger or better than a one lot. You can start with a one lot. It is not beneath you. And then, Dan, you start scaling from there. You go, 1 to 5 to 10 to 5,000. What's the MTM scaling procedure?
Yeah. Now, once you have more flexibility because you got your sea legs with this and you get it and you're ready to allocate more capital, we start to think about things a little bit differently. Like, yes, from a very basic novice standpoint, okay, go from 1 lot to 2 lot to 5 lots, 10 lots, 20 lot. But when we start scaling like that, the difference between an option on a $10 stock and an option on a $2 stock becomes orders of magnitude different. So that's when we really have to change our mindset from contract size to capital at risk. And the good news is it takes a little thinking about and learning about in order to really get how to do it, but it's not really that hard. And in fact, most brokerage platforms are going to make it really super easy for you because most of the time, not always, but most of the time, the amount that your broker margins you is the amount of money you can lose. Now, there are a few exceptions to that. But like if I'm trading a credit spread, it's a $5 wide credit spread. I sell it at $1 and it's $4 that I'm risking to make one, which is $400 of money per contract. If it's a 5 lot, I'm risking $2,000. Okay. So now all of a sudden I've got a way to think about this. I've got a better way to think about this. Buying calls. Okay, I buy a $2 call. What's the most I can lose? Well, $2 or $200 a contract. Okay, I buy a 10 lot. Well, there's $2,000. So what we have to do is set what is the most that I'm willing to lose on any one trade. And there's a lot of psychology that goes into this too, because you can really, really easily trick yourself on this and say, well, yeah, but I mean, I'm never going to lose the maximum amount because, I mean, if it starts to go against me, I'm going to close it, which is just a big fat lie because every now and then the bad thing happens, the overnight gap happens, and it's like, whoa, what happened? My stop didn't work because it was an overnight gap. I just lost way more than I thought. So we always have to use this concept of maximum loss, which, again, mostly coincides with margin. Set a dollar amount that we're willing to risk on each trade. I'm not going to say the words willing to lose, willing to risk on each trade. In fact, willing's a poor word. We're setting up basically what I call compliance thresholds. This is my maximum trade size from a risk standpoint. That's a better way to say it. Not how much am I willing to lose. That's almost like a gambler way of saying it, unsophisticated way of saying it. What is my trade allocation on a trade? My compliance threshold for my maximum trade size. And you start thinking about it like that, and you're never going to put yourself in a situation where you get caught off guard and say, holy crap, I guess I didn't realize how big of a trade that was. How did I lose $4,300? This is just a 2 lot. What's going on here? So that is that's sort of the basic and most fundamental level as far as allocation goes. I've been working a lot with risk management lately. And there's definitely, we could do probably 10 shows on this, but just keeping it strictly to the allocation, you stick with that and you're in good shape.
All right, listeners. And we always stick with you folks and a little bit of your feedback as we head on into the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right. right, listeners, let's get into a little bit of fun out there. Let's go first to Avery. She has an interesting question. She says, can you explain pattern day trading rules? Are these something that options traders should be concerned about? Well, the latter part, yes, short answer. And, you know, we had all this data on the network not too long ago, the specifics on it. And, you know, we don't have a lot of time left in the episode to devote to a topic like this, but it might be, and again, it's not the sexiest of topics, and it really gets people angry, but it might be something we have to devote an episode to down the road. What do you think, Dan? The whole pattern day trading and the impact for options traders?
Now that is a good idea, Mark.
All right, so Avery, stay tuned. When we have a little bit more time to really sink our teeth into this fun, then we will come back. I will make a note of it right now. A topic for a future episode. Pattern day trading coming to a podcast feed near you. Listen, I know it's everyone's favorite thing. That's why we don't get into that stuff too often. People are like, oh God, pattern day trading. But you know what? You got to be aware of this stuff out here. Let's go out to Mackenzie. That's one of our pro members, I believe, Miss Mackenzie. She's our crypto head. Oh yeah, it's a crypto question. Sounds like her. She says they are talking about launching an options market for XRP, aka Ripple, listeners. Can you visualize a use case for an options market when the underlying is only 50 cents? Yeah, short answer, not really. I mean, I joke about this with Greg whenever he's on with the crypto rundown with me and talking about the prospect for that and some other people. It seems kind of laughable at the end of the day. You could buy the permanent call, the forever call that never expires for 50 cents, which is cheaper than a lot of the options trades you're going to do in your regular options trading on a day-to-day basis. And now instead, you're going to go out and buy options on the 50 cent that might expire in a few weeks or months or maybe a year for a significant percentage, a significant portion of that 50 cents. That doesn't make a heck of a lot of sense to me. At that point, 50 cents, the underlying is an option. If you want XRP, and again, I know it's hard to get because it's still under, regulatory review by the SEC. But yeah, I don't know. Dan, are you down for options on a 50 cent underlying, sir, regardless of what it is?
Well, I mean, maybe. I mean, I don't know why we need options on that, but like if you think about how futures options are priced, like it just scales. Like, I mean, you could have 50, the 50 cent strike, the 50.5 cent strike, 51, 51.5, 52, and you could make the multiplier more than 100. You could make it a 1,000 or something like that, like they do in commodity options, where like one corn contract, it's $50 per penny, and you start thinking about it that way. I think if they did it in such a way where the multiplier was something much bigger than 100 or $100, like it is with equity options and index options, it could make sense from a financial engineering standpoint. But I don't know. I mean, I guess my question is, why the hell do we need options on Ripple?
Yeah, a good example, Oatly. It got down to 50 cents not that long ago. We were talking about it. It's been one of our fun play around names on options oddities. And I just bought more at 50 cents. I didn't buy options. I know the Rock Lobster ended up buying some par calls for a nickel. And they ended up working out. So it can be done. But at the end of the day, I'm always going to opt for the underlying, the permanent call at that point. All right. I got time here for one more before I got to get going to our next show here, listeners. Man, no rest for the wicked. The producers hate me. They hate my voice today, listeners. Let's go out to Yotam Cohen. And he says, hi, all. Writing here for OBC. Well, you sent it into the right show here, Yotam. He says, I'm a long fan of the various shows of the network and have been binging since episode 1 when I started. Wow, well, you're the reason episode 1 of Options Bootcamp remains so popular to this day, Yotam. People like you. We love you all out there. Thank you. He says, you guys are doing an amazing job making options trading accessible and fun. Well, again, thank you very much. And thanks for taking the time to write in. We appreciate you all out there. He says, I've got a practical question. How does one accurately evaluate historic volatility versus implied volatility? And he puts in parentheses, for example, to understand if volatility is underpriced in an ETF following a big change in their holding. Again, for example, XLK going from 4% to 20% NVIDIA instead of Apple going the other way. Thank you, Yotam. Well, that's a great question. We talk about historic, aka realized volatility versus implied all the time. Obviously, historic is going to be what you see when you look at a historical graph, or realize it's what a name has actually exhibited over time. Implied is what the market's best guess of what vol is going to be in the future. So there's obviously going to be a difference. Implied is usually higher, hence that term we talk about a lot, the risk premium out there for a lot of these names. That's why a lot of people like to sell options, because the implied is usually higher than the realized, so they can make money doing that. That said, when the fundamental mechanics of an ETF, the holdings change, it can impact the game a little bit. Now, Yotam, your question came in, I think it came in last week, right before Volatility Views. So the producers kicked it to me, and we actually discussed it on Vol Views last week, because I had some folks on there, like our buddy Mr. Dr. Vix and other, who actually do crunch these numbers and do this type of historical research all the time. So I thought, what better opportunity than to put it to them as well. So I encourage you, if you're just listening to Options Bootcamp, get the full network or go find Vol Views. It's on our website everywhere else. Listen to last week's episode. I forget the number, but we're getting close to, I think, 600. But go check out Vol Views from last week. We did do an in-depth deep dive into your question. I do believe Russell's findings were that it doesn't make as much of an impact on the vol performance as you might think. Now, obviously, that's a subjective thing. If the holdings of the ETF are fundamentally transformed, then yeah. But in this case, going from 4 to 20%, it may not have as much of a bearing on the vol performance as you might think. Dan, anything you want to add here for Mr. Yotam, who's a longtime listener, loves the show, been listening since episode 1?
Yeah, well, first of all, thanks for listening. Makes me feel good and like I'm doing a service and not wasting my time. So, you know, I think that the answer to this question is that from a mathematical standpoint, it is going to make a difference. But for, you know, mere mortals, which I'm throwing myself in that group too, not somebody like Dr. Vix, who is a professor, PhD, and can literally crunch these numbers, like have a big knowledge of higher math. Us mere mortals, it's really hard to take advantage of that, because you've got to do the math. You got to do that complex math and figure out, okay, how much is this going to literally change the volatility? And, you know, the best tools that we have is kind of like what Mark mentioned, you know, just think about, okay, well, we have this very volatile stock going from 20% to 4% or whatever. So the volatility of the index is going to be lower, but you need somebody like Dr. Vix to tell you exactly how much that is. And when you have that, you know, you can make some money. A way to capitalize on that would be something like, you know, selling straddles, or what I would prefer to do is to sell butterflies just with really wide wings, so that when the volatility is lower, you end up making money on the Vega portion of that. But that can be really complicated too. I know that even as a professional trader, I got caught up in a couple of traps like that, where the answer seems kind of obvious, but without really having a solid insight on the literal math of it, you can end up shooting yourself in the foot.
All right, listeners, we got to get on out of here for this week. I got Dan the Man Gramza waiting for me to talk all sorts of futures, double header of that. So if you're hanging out in the pro, you'll be getting that instantaneously double dose of double Dans. Can you handle it? We'll have to call Wednesday Double Dan Day going forward. So if you're in the pro already, just hang out. I'll be back instantaneously talking all sorts of futures fun on the Futures Rundown. If you're not in the pro yet, what the hell are you waiting for? So much great stuff over there. TheOptionsInsider.com/pro is the place to go. And of course, check out public.com/optionsbootcamp. Great way to support the show. Keep it running. If you're like Yotam and the rest, been listening, or you're going back and listening from episode 1, you want to have another 100 odd episodes coming at you over there, then go to places like public.com/optionsbootcamp. Costs you nothing. Lets them know you're coming to them from our show, and it keeps them coming back for more, which at the end of the day is a virtuous circle for all of us. Great question, Yotam. At the end of the day, yeah, I think I think you're okay. Intuitively might seem like you can't trust those historical numbers anymore. They're not relevant to what you're seeing now. But at the end of the day, what we've seen empirically is that it doesn't make that much of a difference. So you should be okay relying on those to kind of plan out your future strategy. But a great question. Clearly, you've been gleaning a lot from the show. So we are, Dan and myself, are personally responsible. We'll take all the credit for all the options knowledge you have clearly amassed. You are becoming a very knowledgeable and competent trader. So congratulations to you. Thanks to everybody who takes the time to listen, to rate and review and write in. We appreciate you all. And Mr. Dan, if they want to write to you and come see you, where should they go? What should they do?
Yep, you know where to find me. MarketTaker.com, 2 T's in a row. And yep, that's where you can find me. Ask me anything about option trading.
Dan, why are you so hideously deformed? No, ask him only about options trade. That's from that banter that listener was talking about. That great amicable banter we have, Dan. Check him out over there at markettaker.com. Don't forget the second T for Theta. We got to get on out of here, but don't worry, I'm not going anywhere. No rest for the wicked. Right back with some doubleheader of futures rundown goodness. Then we're back again next week, another episode of Options Bootcamp. Stay safe out there, everybody.
If you trade options, you've got to ask yourself, why would you choose an options trading platform that puts investors first? At public.com, there are no commissions or per contract fees. And more importantly, it's the only platform where you can earn a rebate on every single contract traded. That means you can save on your options trading costs and keep more of your capital in play. Whenever you trade options on Public, your savings are automatically applied. So, don't change your strategy, change your platform, and see the difference in your bottom line. No commissions, no per contract fees. And it's the only options trading platform where you can earn a rebate on every contract traded. To learn more, please visit public.com/optionsbootcamp. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.